Returns in election years, full calendar year, are actually pretty good. And so you shouldn't take this as me saying there is going to be an utter catastrophic drawdown as we round out the year here. But I do think people just need to be prepared. Their expectations need to be set accordingly because we've seen a market run, we have weakening economic data, and we have a very polarizing election that's coming up. That points to volatility for me.
Yeah, and from a seasonal perspective, it lines up with the concept of sell in May and go away, May through the end of October being seasonally weak. But I just read, there was a stat talking about the elevated performance from November through April, but you still needed to be invested from May through October.
Hello and welcome back to another edition of the Blue Chip Partners Quarterly Edge, in which we discuss our outlook for the upcoming quarter. Dan Seder, Daniel Dusina. Dan, where should we start?
Daniel, thanks for having me. Let's start with the equity markets. And I think a big topic that we're all talking about is what's going to happen in November. So with the presidential election coming up, what does that mean for volatility in stocks?
Well, I would say, first and foremost, I do expect volatility to arise this summer that's upcoming. So taking a half step back, you obviously have this election that's forthcoming. But at the same time, we already have economic data that has started to deteriorate quite meaningfully, I would say, relative to the last time we spoke in this forum. So when you combine the two, I think it's just destiny that we start to see some choppiness, especially after a fairly magnificent run when you combine 2023 and the first part of 2024 in the equity markets. Now, that being said, just because we see a bit more choppiness in the equity markets, that doesn't necessitate some odd failure of price action in the equity markets. So I think what I'll do is I'll show on the screen with cognizance that June to August, call it Memorial Day to Labor Day, is traditionally a weak period, seasonally speaking, in the equity markets, just by and large, regardless of election year or not. When we look at election years, it can be slightly more severe, especially when I believe we have these economic underpinnings that are adding some elements of volatility. So when you look at the average year, I'm just looking back to the year 2000, so between 2000 and 2023, the average drawdown, negative price action in the equity market from peak to trough between the months of June and August is about negative 8.8%. So you get a negative 8.8% drawdown on average in any year between 2000 and 2023. In election years, it's moderately more severe. Going back to 2000, the average drawdown in election years between June and August is about minus 9%. But I'll also call your attention to the table on the bottom that shows you the return over that same period, June to August in election years, is actually still positive.
Right.
And then just as we talked about in a blog post we put out earlier this year, if you haven't looked at that, I would encourage you to go to our website and look at the blog post and analysis we did on equity market returns in election years going all the way back to the 1920s. Returns in election years, full calendar year, are actually pretty good. And so that's actually supported by the data that we have on the screen here as well. So you shouldn't take this as me saying there is going to be an utter catastrophic drawdown as we round out the year here. But I do think people just need to be prepared. Their expectations need to be set accordingly because we've seen a market run, we have weakening economic data, and we have a very polarizing election that's coming up. That points to volatility for me.
Yeah, and from a seasonal perspective, it lines up with the concept of sell in May and go away, May through the end of October being seasonally weak. But I just read, there was a stat talking about the elevated performance from November through April, but you still needed to be invested from May through October. Returns weren't as spectacular, but they were still positive.
Yeah, and that's the tricky thing, right? I mean, if we had a crystal ball and could time markets perfectly, I don't think we'd be working day jobs, right?
Right.
But the fact of the matter is, and we'll talk a little bit about this if we discuss fixed income, but markets can move really quickly, especially when you have something like a U.S. presidential election. A lot of the time, what we see in election years is that weakness through the summer months. And then once that layer of uncertainty is removed, regardless of who's sitting in the big chair in the Oval Office, the market starts to breathe a sigh of relief.
Yeah.
So I think there's a high likelihood of us seeing something similar, given the economic data, given the volatility that might come this summer, and given the polarizing nature of this election. I think there might be a sigh of relief that's kind of breathed later on. Now, that being said, like Dan said, you can't necessarily just try to, throw a dart at a dartboard and get the date right.
Yeah.
We don't see anything that is cause for sheer concern, but just be prepared.
Yeah, that's really insightful. Okay, well, you teed it up for me. We were going to go into fixed income next. So bonds, you've been really bullish on bonds in past, quarterly Edge editions, just in some of our content that we produced. Are you as bullish on bonds today as you have been in the past?
I am. The short answer is yes, I am. And I won't belabor the points that were made 3 months ago in the last edition of the Quarterly Edge, but they are all still relevant. So if you haven't watched the second Quarterly Edge that dives into the bond market and talks about why higher starting yields matter, why potential Federal Reserve action can be beneficial, it's all still relevant. If you haven't seen it, go watch it, but I'm not going to belabor it today. What I would say is in line with what you talked about with regards to staying invested. I think that's very much true of the bond market right now as well. Probably even more so than the equity market from a certain standpoint. That standpoint being, I don't think people follow the bond market as closely as they do the stock market. Right. I think it's just natural.
And it's the quote unquote, the smart money, right?
Right. And so, when I tell you that we've seen almost a 4% uplift off an April bottom in the bond market, people are generally surprised.
Yeah.
Just like people are surprised to hear that we've had almost a 10% run in the bond market since October.
Right.
And so that's kind of a precursor to my whole point here. I still think your value proposition is incredible. You have higher starting yields. After the Fed stopped hiking rates, you have not had a bond market that's kept up from a return perspective like you've seen historically. And if you look out farther, regardless of if the Federal Reserve cuts this year or next year or how many times, that proposition is still there. And once expectations around the Federal Reserve do change, the bond market's going to move fast. And you've seen the bond market move fast at points this year already. We started the year with 6 to 7 expected rate cuts. Now we have 2 being priced in by the market. And that's even a change from 3 months ago. And you've seen how the bond market can change. And so what I'll show on the screen right now, I'm showing 2 separate dates that marked recent bottoms in the bond market. In blue, I'm showing the bottom that was experienced by the Bloomberg US Aggregate Bond Index on October 19th of 2023. And in green, I'm showing the bottom of the market that was experienced on April 25th of 2024. And then through the chart, you can see how many trading days has been since the bottom and the cumulative total return. And what you'll see is that, again, these moves can happen pretty quickly, pretty swiftly. You saw about a 6% return for the bond market in November. That's your entire year's worth and more of a money market fund return, right?
Yeah.
And so in brown, as the legend would suggest, I'm just showing you a money market fund that's going to yield 5.3% annually and how that stacks up relative to catching the bottom in the bond market. Now, just as we talked about previously, you're not going to catch the bottom perfectly. But even so, I could show this data and pick somewhere in the middle, catch some of the drawdown and all of the upswing, and your return proposition will still be better than sitting in cash, sitting in a money market fund.
Yep.
So what I would say is, yes, that once in a decade investment opportunity still exists because the ag is roughly flat this year. And I would much rather be early than late and get paid while we wait.
Well said. I don't know if I can add anything to that. Thank you. Daniel, last concept. The buzzword out there right now, and it has been for probably the last year, is AI, artificial intelligence. There's a lot going on, and it's evolving rapidly, right? Rapidly. And so walk us through some of the investment implications of AI and what it means for investors.
Well, first and foremost, I think you hit the nail on the head. The buzzword of the last 2 years, essentially.
Yeah.
And that's important because to a certain extent, I think companies are somewhat leaning into artificial intelligence and not necessarily just from a business investment standpoint, but they're talking about it because they know the more they talk about it, the greater perception they're going to have among the investment community.
And it's not just tech companies. These are companies across the spectrum of sectors. I mean, you're seeing it across the board.
Yeah, I mean, that the common question that we got right when the whole AI conversation started to flare up was, are we invested in artificial intelligence? And my response would generally be something around the lines of, well, what sector do you want to hear about?
Right.
I can talk about how we're exposed to AI in healthcare. I can talk about how we're exposed to artificial intelligence in industrials, even utilities.
Yep.
So I guess the point being, it's ever prevalent. It's evident everywhere. And more companies are talking about it. So what I'm showing on the screen right now is a simple snapshot of the number of companies that cited AI on earnings calls over the last 10 years. And you can see it's no surprise that the last quarter of reporting results, we hit an all-time high of 199 companies within the S&P 500 said or cited AI in some capacity. So number one, it continues to be very important, and I do think it actually is looked very highly upon by investors. So the management teams of these businesses that are citing AI, even if they are not heavily and rapidly deploying investment into artificial intelligence, they still want to talk about it because
that's what investors want to hear.
Right. So that's first and foremost. So that's been evolving pretty significantly. The other thing I would say is just to keep in mind how dramatic the explosion of artificial intelligence has really been from a return perspective. And it's not necessarily founded in actual earnings growth quite yet. So when I look at key AI players or a select subset of artificial intelligence directly exposed companies, in this example that I'm about to talk through, I'm just using an ETF as an example. I think it's the Wisdom Tree Artificial Intelligence and Innovation ETF. But what you've seen is a really big hype cycle. And when I say hype, I think it technically is correct because it's not necessarily founded in actual profitability yet. There's just a lot of excitement. And so that hype is reflected in a massive degree of market capitalization growth without necessarily having earnings growth to support it. So if you look at the date that ChatGPT was launched, November 30th of 2022, and you look at today, the amount of sheer market capitalization in that ETF I mentioned, those individual companies, that has been added since that date, it's $9.7 trillion. So $9.7 trillion of market value has been created through this artificial intelligence hype. It's hype because the amount of net income that was added in those same companies over the same time frame was $65.3 billion. I mean, it's a big number, but relative to $9.7 trillion, it's nothing. The growth rate of market cap is 87.2% over the period. The growth rate of net income is 14.2%, right? So I think that is just something to be aware of. It's not a comment in favor of or against artificial intelligence in any capacity. I just want to call it out because I think people need to be aware of how quickly and how technically unsubstantiated some of the value creation has been right now. And I think a rebuttal to that would be, well, yes, we haven't seen profitability increase yet. We wouldn't expect trailing profitability to increase. We're pricing this based on future expectations, right?
The market is a discounting mechanism for what's coming down the road.
Yeah, and certainly that can be true. Yeah. But what I would say is that was also what people were saying in 2000, right? Yeah. So when you look at some of the darlings of the tech bubble, I'm showing Cisco Systems, Oracle, and Qualcomm. What I'm showing is the period of time since they reached the stock's high in the year 2000 and how many years it took those companies' stocks to recover back to just even, not even talking about positive, right? Cisco is technically still resting below its 2000 high. Oracle, it took them till technically about 2020 to recover. And then Qualcomm, same deal, close to 2021. So I guess the point is, and I'm not insinuating that buying into some of the hypiest stocks right now, like an NVIDIA, is going to essentially result in this. That's not what I'm saying. I'm just saying be aware of this, right? Yeah. Because right now, just as there was in 2000, there is a lot of excitement around future profitability, new use cases, innovative business models, and a lot of FOMO, fear of missing out. You just want to try to make sure that you're comfortable with the potential risk you're taking. And I would say the last thing is that there are a lot more creative ways to play artificial intelligence relative to just the companies that are in the headlines. And to your point earlier, not just the companies that are in the information technology sector.
Right.
One knock-on effect that you have from this massive utilization and push into artificial intelligence is that artificial intelligence uses an immense amount of data. That data needs to be stored, so data center usage will tick up. And data centers are a huge user of power. They have to be operating 24/7. And a lot of the power consumption growth over the next 8 to 10 years is expected to come from data centers. So what does that tell me? That tells me that if this artificial intelligence hype comes to fruition in a true fashion, we're going to need to build out the grid in a very, very large way. So that's companies that participate in building out gas turbines. It's companies that participate in building out the transmission side of the grid. It's utilities that are deploying capital to make sure that sufficient amount of power is being available to these new data centers. So there are so many different legs that come off of this artificial intelligence topic.
Yeah.
You see a lot of the usual suspects in the headlines, but there are so many other ways to allocate from an investment perspective that might not necessarily be solely reliant on this theme working out for the companies to generate strong returns in the future.
Yeah. Keep our eye on margins moving forward. You'd expect if the artificial intelligence boom continues that companies should be able to leverage that those advancements and be able to increase margins, materially down the road, meaningfully down the road.
Yeah, absolutely. So there's a lot to unpack there. And we've spent a lot of time over the last 2 to 3 months unpacking that whole landscape, kind of diving deeper into the power consumption theme. We may or may not put some of that research out to the public, but either way, we're always excited to have a conversation around it if it's of interest to you. Yeah.
Good stuff. Good stuff. So, Daniel, we've covered the election. We covered stocks. We covered bonds. We covered artificial intelligence. Is there anything else that we want to cover before we call it a wrap?
No, I think the tagline for the upcoming quarter is expect volatility, but be pleasantly surprised if the trajectory that we've been on continues, which I don't think is an unrealistic assumption to make.
Great. Fantastic. Well, I think that's all for today. We'll call it a wrap.
Yeah. Thanks, everyone, for joining. Continue to tune in via YouTube on our Blue Chip Media channel or check out our website, bluechippartners.com. Always happy to have you, and we look forward to speaking with you again soon.